Thanks for watching my webinar. My name is Eric Martineau, and that is my contact information. I have been teaching people for about the last 7 years that private equity banking is the tool which allows us to break the chains of debt, usury, high interest rates, and excess taxes, while at the same time building tax-free generational wealth. I often get the question, how does private equity banking actually work? So I'm going to walk through the mechanics today to help people better understand this, because I get this question all the time. Before we go into the mechanics behind private equity banking, first I want to kind of give you an overview of what it is. First of all, this is an IRS sanctioned cash accumulation contract. That's what the IRS calls it. Cash accumulation account or cash accumulation contract. That's what the IRS calls this. Okay? What does it provide you? It provides you with your own stable bank. In that bank, you're going to have tax-free growth and tax-free use of all of your funds. So once it's in there, because it's post-tax, all of that money is available to you in a tax-free environment. Secondly, you have liquid cash. Anytime access to that money, no age restrictions, like say a 401k, and it comes free from any fees and closing costs. Another protection that you get with a cash accumulation contract is just that protection from creditors and lawsuits. People can't get at your money, and from bank failures like we saw last year with Silicon Valley Bank. You also get guaranteed returns. So remember, cash accumulation account or cash accumulation contract. Because it is a contract, you get guaranteed returns. So it's not like what your financial advisor says, oh, well, if my portfolio does this and this, or if Wall Street does this and this, then you'll get that. No, this is guaranteed, it's contractual, so you're protected against unpredictable Wall Street markets. Compounded interest. All of your cash value and all of your dividends get compounded interest. Also, you get dual use. And this is a hard concept for people to get, but you end up with two plates of money. You get a savings account and you get a loan account. Both of those are going to be earning interest. That's what I'm going to explain here in a second, is how to use your money twice simultaneously. And then finally, you get stability. You are partnered with some of the most powerful and stable insurance companies that have been, all of them have been around for over 100 years, paying dividends every single year, even through the Great Depression and all the recessions that America has had in the last 100 years. So now let's get into the actual mechanics of how it works. Okay, to understand a private equity banking account, we need to first understand what a typical whole life account looks like. On day one, with a typical whole life insurance policy, and I don't sell these, you're going to get premium, you're going to get cash value, and you're going to get death benefit. Inside the premium plate, there's a little saucer there that I want to call target premium. And if you put in $100 into target premium, you're going to get about $5, that's all, $5 in cash value. And you're going to get some death benefit. That is a typical whole life insurance policy. I don't sell those. Why? Because it's low cash value, only $5 to every 100 you throw in there, about, and you get restrictions on your cash value. In other words, you can't use that money, even though it's only $5, you can't use it for between 5 and say 15 years. Okay, that is why I do not sell typical whole life insurance policies. But don't get turned off because you've heard the term whole life insurance and somebody's told you it's a bad idea. I do not work with typical whole life insurance. Here's what we do. We do private equity banking accounts. Now, the IRS calls this a cash accumulation contract. I call it private equity banking. It's still whole life insurance, but it's structured properly. So here's how it will be structured. Now you're going to get high cash value. So instead of the $5, you're going to get, let's say, $60. Now, some of them will be upwards of 80. It just depends on what you're doing. Again, I'm going to use 60 because that's more conservative, but just understand, depending on what your needs are, it could be a little bit more than that, right? and then there's no restrictions. In other words, you're still going to get this plate with an insurance loan attached to it. Let me explain how that works. You notice that there are two separate plates there. Well, one is your cash value, which never goes away, and the other is an insurance loan, which you're able to borrow against, okay? And then obviously you're still going to get death benefit. So let's say that you've put $2,000 into this target premium, and I don't care if you put that $2,000 in on day one. I don't care if you put that in over a number of months or a number of years. Let's just say you've got $2,000 in there. Well, instead of getting the $100 that you would normally get in a typical policy, so you're going to end up with about $1,200 in cash value, and you're still going to get even more death benefit. But remember, you still get this loan capability. And that loan capability, as I said, doesn't matter if you put that $2,000 in on day one or month one or year one. I put day one up there to emphasize the fact that you have access to your money that's in the cash value portion on day one. And so that entire amount, that $1,200, is available to you in a loan. This is one of the most important components to try to understand in private equity banking. You see, that $1,200 that you have in the high cash value area is earning interest for you, and we take out a separate loan for $1,200, and you're paying interest on the other. So you're using your money twice. I'll explain that. So the high cash value portion is earning, let's say, about 5%. Again, different companies make different offers, but let's just say it's right at about 5%. And the insurance loans are running right now at about 6%. So there's a difference there of about 1%. I've never seen it even get to 1%, but again, I'm trying to be conservative here. But that spread between what they pay you and what you can borrow at is usually less than 1%. Okay? All right, now that we've got those fundamentals down, let's move on to this and show an example. Again, I'm going to say week one. You could put the whole amount in there because I want to emphasize the fact that there's no restrictions on that money, and you could use that money immediately. So let's say you've got $1,200 sitting in there. And again, it doesn't matter if you put that in on day one, month one, year one, doesn't matter. It's now earning 5% for the rest of your life. In other words, $60 a year. If you wanted to borrow money, that's costing you $1,200, in other words, 6% or $72 a year. What's the difference? 1%. So really, you're able to borrow $1,200 and only pay 1% on that, or $12. This is what makes private equity banking such a powerful tool to get out of debt. Let me explain why. Well, first let me ask this question. Is a 1% interest rate considered excessive interest? In other words, usury. Usury is defined as excessive interest. Is that excessive interest? I think not. Okay, what about a credit card? Let's say you've got a credit card. What's it at? 29%? You would be paying $348 in interest. Okay? Is 29% an excessive interest rate or usury? I would say it is. The question then becomes, should the person that has this $1,200 sitting in their cash value account borrow $1,200 at 6% to pay off their credit card? Well, of course. Let's look at the math, right? How much does he actually save? Instead of paying $348 in interest, this person's only paying $12. So how much do they save? 28%, or $336. Let's add some zeros to this. Let's say that your high cash value account has $12,000 in there, earning 5% for the rest of your life. That's $600 a year. We also know that you have available to you $12,000 at 6%, which you would pay, say, $720 in interest a year. Well, what if you've got a credit card that actually has $12,000 on it at 29%? So that person is paying $3,480 in interest to the banks. This is where this gets powerful, because see, you're going to become your own bank. So what's the difference there? Well, $3,480 versus $120. That's a savings of $3,360. All right. So again, the more money you get into your high cash value account, the more money you have available to borrow. So let's say that now you've been putting in Let's say you've got $75,000 in there and you want to go buy a car that's worth, say, $52,000. You're going to earn $2,600 on that money that is in your cash value account. Now you're going to go get a loan. So you're going to pull that out for $52,000. At 6%, you're going to pay $3,120 for that money. All right? And then what's the total cost between the two? The net effect, $520 or 1%. Instead of, if you went to Volvo Finance or whoever, let's say they gave it to you at 7.5%, you'd be paying $3,900 for that car. So you now just saved $3,380. All right? Let's take it a step further. Let's say that you now want to get into real estate. I'm going to use my real numbers on this one. I currently have put in $240,000 into my policy, and I have just over $220,000 in there. So I'll show you my actual policy at the end of this presentation. Well, I've got 220 there, growing at 5%. So I'm going to make 11%, right? And I want to go get a fixer-upper. So let's say I buy a torn-up old home at 150, and I got 70,000 now available to go fix it up. I go fix it up. First of all, no payment plan. Real estate investors. If you buy a property like that, sometimes they make you make payments until you get the thing flipped. And if you can't get it flipped, you're still making payments on that thing. Well, in this case, there are no payment plans. Also, there's no closing costs for that money and no fees. So you go borrow that money. And by the way, again, I'm talking about it being available in week one. The reason is if you had that kind of cash to lay down, and a lot of people do, you'd have this available in week one. But it doesn't matter if it took you 4 years like me or 8 years. I don't care. As long as you've got the money in the cash value account, you can then borrow it. So let's say I can borrow at 6%. That's $13,200 that I'm going to pay, or a total net for the year of $2,200. If I went out to get hard money, I'm going to be paying what, 12%? So that'd be $26,400 or so. And again, real estate investors, you understand this. There's no payments. There's no payment plan. And so I could just wait until this thing actually does sell at the price I want it to sell at. And if it took a year, that's $24,000 that I don't have to make when I sell that home. That goes back to my bottom line because I only paid $2,200 for that cash. And if it took 2 years, I've paid $4,400. You get the idea. With no payment, that you don't have to make a payment because it's not a scheduled payment plan. So again, what's cool about this is that there's no payment structure, and you can pay it back when you want. So it's a great, great, great way for real estate investors to do fix and flippers. Or just buy it, fix it up, and hold it for 6 months, and then go refinance it, get your money back out, and then pay that off. So there's a lot of things you can do as a real estate investor with high cash value insurance policies. All right, so to recap, you put in $100, you get about 60. You have 60 available to you as a loan, all right? But now I want to bring in the next concept, and this is the key to understanding the power of a private equity banking account, and it's called paid up additions. Remember when your high school teacher would say, pound on the floor and say, this is going to be on the test, this is going to be on the test. This is the most important part, paid up additions. Now, you don't have to memorize that word. Just remember, this is the savings account. Now, a portion of your premium is already going, as I said, into paid up additions. That's what this cash value is made up of. So now, when you put in $300 into paid up additions, or in other words, the savings account, it's almost a 1-to-1 ratio of what goes into the cash value. Yeah, there's a little bit that they take off, but at the same time, they're going to add in that interest of 5%. And so really you're getting the 300 plus about $15 in interest that year. So immediately when you put in 300, you're going to have almost that entire 300 available to you as loan. This is why it's so important to fill this bucket up, the cash value plate up with paid up additions, because it's not really costing you much at all to do that, whereas the target premium there is. But the thing is, you got to pay the target premium to be able to put in the paid up additions, okay? Also, another thing that's super important is that because all of this is underneath an IRS guideline, there has to be a ratio consistent ratio between the amount of premium you pay and the amount of death benefit you have. So you cannot buy paid up additions without also increasing the amount of death benefit that you've got. Otherwise, the IRS says, oh, this is just a savings account, and therefore it's taxable. That's what keeps this thing growing. So you're supercharging the death benefit and you're supercharging the cash value. So again, folks, this is what's on the test. Paid up additions, i.e., the savings portion, is, in my mind, of a properly structured policy, the most important part. Why? Because PUA, paid up additions, will 3x the speed at which you can, one, eliminate debt, two, finance your lifestyle, and three, build wealth. And it's almost a one-to-one ratio of how much money you put in is what you've got in cash value. Let me give you an example, and I can only use myself. So this is my real policy. You'll notice that my annual premium is $60,000. When I first heard about this concept, the gentleman showed me, he said, hey, I can get you out of debt in 5 to 7 years. And he came up with a number of about 700 and I think it was 40 or $780 a month. I don't remember what it was, but it was somewhere right there in that range. And he said, you know, I can get you out of debt in 7 years. Well, as soon as I understood the math, I said, no. I don't want to get out of debt in 7 years. I want to do it in 2 or 3. So I want to put in $9,000 a month, not $740 a month. He goes, slow down, cowboy. And so what we ended up doing was $5,000 a month or $60,000 a year. I've been putting that in. Now, all of these numbers are end of year numbers. So I'm now in my 4th year with my policy, okay? And I have about 199,000. Again, this was the illustration he gave me on day one. This was the guarantee. This isn't like an illustration that you get from your financial advisor that says, if the stars align and the market participates in this crazy thing we call Wall Street roulette, if all those things play out, then you'll have this. This is not what happens with a whole life policy. He told me you will have at least 199,933. In fact, I shouldn't even have more than that. But I went out and pulled up my website with my policy on January 30th of this year. Now, my policy annual begins in October. So this is October, November, December, January. So 4 months into this year. And remember, at the end of this year, I'm supposed to have 199, but you'll notice right now I already have 220. So 221 almost. So where did I come up with an extra $21,000? Simple. PUA, paid up additions. Okay, and I get that in there as soon in each year as I can. That way, one, I have it available to borrow, and two, I know it's building interest for me for the rest of my life. That's an extra 20,000. I didn't have to go out and get a side hustle to do that, right? It's just because I understand the simple math of get your money in as soon as you can in each fiscal year so that it's earning interest for you. And by front loading the PUA or the savings portion of your private equity banking account, you're going to build more interest quicker. And as you can see with my real example, with my real policy, I've got an extra 21,000 sitting there right now over what I would have been or what I was guaranteed to have. By the way, all of these families here have been doing this. All of these companies have been doing this. This is a very, very popular protocol amongst the ultra wealthy. And the thing that's so beautiful about it is that you can take advantage of it too. So let me ask you a couple questions. How much wealth are you giving to the banks? And is that the legacy you really want to leave your family? If you were completely debt free, what would you do? If there really was a way to eliminate all of your debts, credit cards, mortgages, all of that in 5 to 7 years, and that's what the gentleman approached me saying in the first place, when would you start? So reach out to me. Let's sit down together. It doesn't cost you a thing. We can build an illustration. We can talk about your financial goals. We can figure out how long it will take to get you out of debt if that's necessary. We'll figure out how long it's going to take to get to the point where you can actually finance your lifestyle at less than 1% like you'd like to, and build the generational wealth that you want, which is all going to be tax-free. Look forward to working with you. Get a hold of me. There's my information right there. Go to privateequitybanking.com/calendar, set up a time with me. I'll help you out.